taxpayers. Self-employed taxpayers may be able to deduct certain expenses related to a home office if the space is regularly and exclusively used for business, and it is the taxpayer's principal place of business, or the place used to meet with patients, clients, or customers in the normal course of business, or a separate structure not attached to the home that is used in connection with the business. So it's very common for like self-employed therapists, that sort of thing, to meet patients in a home office, right? When I still lived in Northern California, I actually knew several like therapists and social workers that would meet their clients that way. They would meet them in their home office. That would be classified as a home office if it was regularly and exclusively used for that purpose. You can also deduct a separate structure that's not attached to the home if you use it for a home office. There's a lot of tax practitioners who will set up like a tiny home in their backyard, or like one of those sheds that you can buy that's really nice. It looks like a house on the outside. I have several colleagues that decided to do that. You know, they didn't want to go to the office anymore. So they bought like one of those little fancy sheds from Home Depot and they put it out in the backyard. And that's where they do business now. It's away from their house. They have like a separate structure, and that's where they do all their work. So any of those would be fine, right? It can be, you know, a room in your house that's just for exclusive use for your business. It can also be a separate structure like behind your house. It can be, you know, a renovated garage. You could renovate your garage and make it into your office. All of that would be acceptable as long as it was used regularly and exclusively for your business. A taxpayer can use any reasonable method to calculate the percentage of the home that is used for business. Typically what you do, though, is you just figure out the square footage of the home office divided by the home's total square footage. So, for example, if you have a home office and you were using actual costs for the home office and not the simplified method, then you just take the square footage of the office, divide it by the home's total square footage. It gives you a fraction. And then that's what you use to figure out the percentage of the utilities and expenses that would apply to the home office. Many software programs will do it for you. They will do the calculation for you once you put in the square footage of the office. But, you know, even if your software program doesn't do it for you, that's something that you could do easily by hand with a calculator or an Excel. Okay. Because of the exclusive use rule, a taxpayer is not allowed to deduct business expenses for any part of the home that is used for both personal and business purposes. So the home office has to be exclusive use in order for it to be deductible. A self-employed taxpayer must complete Form 8829, expenses for the business use of your home, and then transfer that total to the Schedule C. In order to take the home office deduction, it has its own form. Now, if in the case you have a partner in a partnership, or for example, a shareholder in an S corporation, in that case, the best way to do it, if you have a home office and you want to take that deduction, is for those entities to reimburse either the partner or the shareholder for those costs under an accountable plan. That's the best way to do it, is for the entity to reimburse. Okay, because if you're a shareholder in an S corporation, you're an employee, right? You're an employee. So there's no way to take that deduction on your personal tax return. If it's an employee shareholder of an S corporation, the way to do it is to reimburse. Now, with partners in a partnership, that's a little bit different. Partners in a partnership are considered self-employed for the most part if it's a general partner working in the business. And you could technically deduct the cost of a home office on the Schedule E as UPE, as unreimbursed partnership expenses. I need to do a video on that because I got a lot of questions about UPE. But you could technically deduct it on the individual partner's return as UPE. There's some hoops that you have to jump through in order to do that. So it's still better in that case, if you have a partner in a partnership, for the partnership to reimburse the partner for those costs under an accountable plan. But if you have a self-employed taxpayer and they're filing a Schedule C or a Schedule F if it's a farmer, then they complete the Form 8829 in order to take the home office deduction. The simplified home office deduction. Now, this is generally what I do. I like the simplified home office deduction the best, and that's because it's so easy. You just take the square footage of the home office up to a maximum of 300 square feet, and then you get $5 for each square foot. So it's a maximum deduction of $1,500, and you don't have to calculate any of the other stuff. No utilities, no internet, none of that. None of that has to be calculated. You just take $5 for each square foot of the office up to a maximum allowable square footage of 300 square feet for a maximum deduction of $1,500. Under this option, the taxpayer can claim the full amount of allowable mortgage interest, real estate taxes, and casualty losses, if they apply, on his or her home as an itemized deduction on Schedule A. That's one of the biggest benefits. You don't have to be allocating between the home office deduction as well as the Schedule A if you use the simplified method. It's so much easier. These deductions do not need to be allocated between personal and business use, as is required under the regular method. The simplified option does not include a deduction for depreciation either. So you don't have to worry if the taxpayer actually owns their home, if they're not renting. You don't have to set up the home on the depreciation schedule and depreciate the property as you would if you take the regular method of the home office deduction. The simplified home office deduction doesn't require any depreciation. So you don't have any depreciation recapture either when you later sell the home, which is a hassle, right? When you have a home office and then you have to recapture depreciation from that home office. Each year, a taxpayer may use either the simplified method or the regular method to calculate the home office deduction. So potentially you could switch back and forth, but I never do. I generally take the simplified home office deduction and that's it. It's much easier. And then what ends up happening is if the taxpayer does own their home, then you can just take the full amount of mortgage interest, real estate taxes, and all of those expenses on the Schedule A, and you don't have to do any allocations between the home office and the Schedule A. Example, Alfred is a self-employed insurance broker with a home office he uses exclusively for business. The office measures 15 by 15 feet, or 225 square feet. Alfred deducts $1,125. This is $5 times 225 square feet using the simplified option. He does not have to calculate depreciation or prorate his utilities under the simplified method. So much easier.
Next webinar covers meals and entertainment. In this webinar, we cover business meals and entertainment.
We're going to talk about meals and entertainment. Lots of special rules here. The Tax Cuts and Jobs Act eliminated the deduction for most entertainment expenses. Most, not all, most, okay? And I'm going to tell you which ones are still allowed. There are still some narrow exceptions. The Tax Cuts and Jobs Act does not affect expenses that are typically not considered entertainment depending on the taxpayer's business activity. The disallowance for deducting entertainment also does not apply to businesses that provide entertainment to the general public. Entertainment that is provided to customers, as well as food and drinks, are not subject to any kind of 50% limit and are fully deductible. For example, the owner of a nightclub can hire a nightly entertainer, and that would be a normal business expense of the nightclub. So if you have a nightclub, for example, and you hire a nightly entertainer or a DJ or something like that, that's not considered entertainment. That's fully deductible. I mean, it's entertainment for the patrons of that nightclub. But if the business itself is providing entertainment to customers, then those costs are fully deductible. Now let me give you some examples. John is a clothing designer. He attends a fashion show to introduce his new designs to potential buyers. The cost for attending the fashion show would not be classified as entertainment because the fashion show is directly related to his business as a designer. Any expenses John incurs during the show would be deductible as normal business expenses, right? So a fashion show might normally be considered entertainment. If I went to a fashion show, it would definitely be considered entertainment. My businesses don't have anything to do with the fashion industry. So I wouldn't be able to deduct those costs. That would just be a fun trip for me. But in this case, John is a clothing designer, so this is not entertainment for him. This is directly related to his business activity, which is the activity of being a clothing designer. So all of the costs associated with this trip or with this fashion show that he incurred would be fully deductible as a business expense. Example number 2. Eugene is a sports writer who covers professional soccer. He runs a profitable YouTube channel with over 1 million followers. We're seeing a lot more of this, by the way, as tax accountants, right? People who make their living on YouTube or make their living online, podcasting or whatever, in that kind of entertainment industry. It's becoming more and more popular. I'm seeing more and more of it. Eugene attends dozens of soccer events throughout the year. He often interviews the players in person and posts the videos to his channel. He asks for player signatures on jerseys and game programs. Eugene then runs online contests for the signed jerseys. All of his income comes from sports writing and his YouTube channel. So he's in the entertainment industry, the sports entertainment industry. The cost of the sports tickets and the travel to the games would be a deductible expense. It's not entertainment for him. This is his business. He's in the entertainment industry. So all of those costs would be fully deductible because he is in the business of writing about sports entertainment. Last example. 5 Star Realty hosts open houses once a month. Now, this is not a business that's in the entertainment industry. This is a realty company. These events are advertised in the local newspaper and on the radio. So this company is a realty company that hosts open houses once a month. And they're advertising these open houses to try to get customers to come in and find out about their services. During the open house, food and drinks are provided, as well as a presentation explaining the property management services that 5 Star Realty offers. The events are open to the general public and used primarily as a marketing ploy to find new business customers. All of the costs, including the food and drinks provided during the events, are 100% deductible by 5 Star Realty. And most of the time, the way that I would report this is probably under advertising. But it doesn't matter how you would report it. The costs would be 100% deductible in this case because they are offering food and drinks to the public as part of an event to basically attract new customers. They're offering meals and drinks to the general public to get them to come in and learn about their services. Meals and entertainment exceptions also exist for company-wide events. In this case, the entertainment as well as the meals would be 100% deductible. There's no 50% limit to the meals in this case, and the entertainment would be 100% deductible. Examples include team building activities, holiday parties, and company picnics. In order to be fully deductible, the events cannot discriminate in favor of highly compensated employees. In other words, all of the employees must be able to participate, not just highly paid executives or company officers. It's commonplace for larger companies especially to have holiday parties. If they do have a holiday party, whether it's, at the office or at a different location, or whether it's after hours or during normal business hours, that's going to be 100% deductible as a team building activity. However, you have to make sure in that case that the events themselves do not discriminate in favor of highly compensated employees or highly compensated sales executives. Okay. It's fine for a company to make it a company-wide party where, for example, the families of those employees are invited. That's pretty typical. So, for example, let's say you have a company party and it's a holiday party. Let's say it's a Christmas party. It's at the end of the year. You have a holiday party. You invite all of the employees to the holiday party, as well as their families or their spouses, their significant others, that sort of thing. That's perfectly fine, as long as all of the employees are actually invited. They don't necessarily have to come, right? Most of the time, these types of events are not mandatory, but you can invite all of the employees as well as their families. And then the food, as well as any kind of entertainment that you might have, like a DJ, would be 100% deductible because it's a team building activity. Now, what some companies try to get away with, though, is they will have like an outing, like a golf outing or some company retreat, but they won't invite all of the workers. They don't want to invite the lower paid workers. They only want to invite like the executives. Oh, our top sales people, or we're only going to invite the vice presidents and the managers to this event, that sort of thing. In that case, that's not a team building activity. That's not the same thing as what we're talking about here. In order for it to be 100% deductible as a team building activity, you have to basically not discriminate against the lower paid workers. Everybody has to be invited. That means Mr. Vice President as well as the janitor. Everybody has to be invited if it's going to be deductible as a team building activity. It can't just be, the 10 vice presidents and then none of the other lower paid workers get to come. That's not what we're talking about here. In order for it to be 100% deductible, you cannot discriminate in favor of highly compensated employees. Okay? Example, Edison owns an auto repair shop with 20 employees. Every year, Edison organizes a holiday party at Christmas time. All of the employees and their spouses are invited to the holiday party. The party includes professional catering and a music DJ. The cost of the holiday party, including the cost of the meals, is 100% deductible as a business expense because it is a team-building event for the benefit of all of the employees.
Business meals. In the current year, businesses can deduct 50% of the cost of business-related meals. Any taxes and tips incurred on the meal are also subject to the 50% limit. Per diem meals provided to employees are also subject to the 50% limitation. Let me explain this. If you reimburse employees for the cost of meals, for example, let's say you have a salesperson and they're working for a company that sells eyeglasses or something like that, and they take a client out to dinner or lunch, and it's business related, it's one of their business clients, and then the company actually reimburses that employee for the cost of the meal. The company can reimburse the employee for the full cost of the meal, or the company can reimburse the employee at the per diem rate, and they can reimburse the full cost of the meal and the full per diem rate if it's done as a reimbursement to the employee. However, the business itself can only deduct 50% of that. So even if the business chooses to reimburse the employee at 100%, the business itself can only deduct 50% of either the meal cost or the per diem. The 50% limit also applies to meals provided to employees as a fringe benefit. For example, if the company purchases like coffee and snacks for the employees to eat in the break room, those are also subject to the 50% limit. Business meals are deductible if they are incurred while traveling away from home, whether eating alone or with others on business, taking customers or clients to a restaurant or other eatery, attending a business convention or reception, business meeting, or business luncheon, obtaining deductible educational expenses such as meals during a continuing education seminar. So for example, if you were to travel and take a CE class, like you go to the IRS tax forum in San Diego or Las Vegas, tax forums happen every single year. If you go to one of those forums and you go to lunch while you're there during the educational seminar, then you could deduct 50% of the cost of your business meal. Whether you decide to take actual costs, like the actual cost on your receipt from the restaurant, or whether you choose to take the per diem, it's going to be 50% of that. Food and beverages that are provided during entertainment events, such as a baseball game, will not be considered entertainment if purchased separately from the entertainment, if the cost is stated separately from the entertainment on invoices or receipts. For example, if you take a client to like a golf game or to a baseball game, you cannot deduct the cost of the entertainment itself if you're just entertaining a client at one of those types of events. But if you have meals during those events and they're purchased separately and you actually have a separate receipt for that, then you could deduct 50% of the business meal, but not the cost of the entertainment. And let me give you two examples. Tamara is a licensed attorney. She takes her best client to a baseball game at Tropicana Field in Tampa Bay, Florida. During the game, they eat at Grand Slam Grill, a restaurant located within the stadium. So they're at the stadium and she's taking her client out to a baseball game, which is fine. She doesn't get to deduct the cost of the game though. The baseball tickets cost $105 each. The meal inside the park costs $80 and she receives a separate receipt. Tamara may deduct 50% of the meal or $40. The cost of the baseball tickets would be a non-deductible entertainment expense, even if some type of business activity was conducted during the game. Sometimes on the exam, they'll give you a question like this, where you'll be forced to calculate the amount of the allowable deduction. And they'll throw all kinds of like math numbers at you. But in this case, she would not be able to deduct the cost of the baseball tickets. And she also would not be able to deduct the full cost of the meal. The only thing that she can deduct in this case is 50% of the meal. So $40 would be her allowable deduction on her Schedule C, for example, if she was self-employed. Example number 2. Jamie is a self-employed realtor who takes a client to lunch to celebrate the closing of a home sale. The total restaurant bill is $88. She also pays $10 in taxi fare to get to the restaurant. Her deductible meal expense is 50% of the $88, which is $44. But she's allowed to deduct the full cost of the taxi fare. If she had like bus fare or if she paid an Uber or anything like that, or even if she used her own car, she'd be able to deduct mileage to the restaurant if she was taking a client out to dinner or to lunch. And she'd be able to take the full cost of the travel expense. In this case, it was taxi. So she could deduct the full cost of the taxi fare. And then the meal expense would be limited to 50%. And that would include any other costs associated with the meal, such as the tip and taxes associated with the meal. But the travel expense to actually get to the restaurant would be 100% deductible. Her deduction on Schedule C would be $54 because the taxi fare would be 100% deductible, while the cost of the meal would be subject to the 50% limit. And then once again, if they tell you on the exam that it's the meal and then tip and then taxes on the meal, all of that is bundled together. Like basically the receipt that you get from the restaurant, you can take 50% of that and that's it. But the transportation actually to get to the restaurant to meet your client, whether you take the Uber or whether it's mileage in your own car, that would be 100% deductible. But the meal would be subject to the 50% limit. Remember that for the test. The next webinar covers travel and transportation expenses. In this webinar, we cover business meals and entertainment.
We're going to talk about meals.
Travel and transportation expenses.
Travel expenses. Business expenses for travel must be incurred while carrying on a genuine business activity while traveling away from home. The taxpayer must be able to prove that the travel is directly related to the conduct of business. So basically, the IRS doesn't want you to be deducting your vacations, right? Okay. Adequate records must be retained to support these expenses. An exception is made for smaller expenses other than lodging that cost less than $75. Technically, this is in the pubs, okay? Technically, if you have an expense that's very small, it's less than $75, then you only need to have like a journal entry saying that you had that expense. But I'll tell you, not very many people pay cash for everything anymore. And in general, if you don't have some kind of proof, like a receipt or a bank record or like a credit card charge, that these charges were made, then it's likely that the IRS will disallow these charges unless you have records that you actually paid for these items while you're traveling. But technically, for smaller amounts, other than lodging, for example, if you stay at a hotel, it doesn't matter if it's cheaper than $75. You need to have a receipt for the lodging. But if you have smaller items, like let's say you go in and you just buy a donut while you're traveling or something like that, you pay $1, you could technically just write that down on a piece of paper and keep track of the cost, and that would be okay. If it's a travel expense that's less than $75 other than lodging. Travel costs for a business purpose are 100% deductible. Commuting costs, however, are considered personal and not deductible. So if you're just commuting from your personal residence to your workplace, your regular workplace, those costs are not deductible. Taxpayers are considered traveling away from home if their duties require them to be away from home substantially longer than an ordinary day's work, and they need to sleep or rest to meet the demands of their work. Okay, this is what it actually says in the pubs. It doesn't say overnight. Okay, it doesn't technically say overnight. I feel like the IRS is beating around the bush a little bit here, and they want to say overnight. Like, you're not allowed to deduct your travel expenses unless you stay overnight, right? But it doesn't say overnight in the IRS publications. It just says that your duties require you to be away from home substantially longer than an ordinary day's work. And you need to sleep or rest to meet the demands of your work. Whenever I read about travel expenses, I always think about some CPE webinar in another city, right? Because I'm a tax accountant. And that's what I'm always thinking about when I think about business travel. Oh, so I'm going to have business travel as a tax accountant. What other kind of business travel am I going to have? I'm going to go to like a meeting or a CPE event, or like, NATP has a tax event going on in some city and I go. That would be the type of travel expense that I would have that would be related to my business. So I'm always thinking, well, if I do go there, I'm probably going to have to get a hotel and sleep overnight. But technically, you could potentially still deduct your travel expenses if you didn't have to stay overnight, if it was a full day's work and then you needed to rest in order to meet the demands of your work. Okay, but yeah, the travel expenses have to be business related in order to be deductible. And of course, it's going to depend on the type of business activity that the taxpayer has, whether or not the travel expenses are deductible or not, right? If it's like a band member, they're a band and they're traveling all around the United States to perform, they're going to have a lot different type of travel expenses than a tax accountant would. Right? They're going to have more travel expenses and they're going to be on the road a lot more than someone like you or I would, right? Okay. So it's going to depend on the type of business activity that the taxpayer is in. Per diems. Now, a per diem is a daily allowance paid by a business to its employees for expenses incurred while traveling. Per diems are really, really commonplace, especially when businesses get very large. For example, large accounting firms, large corporations. Generally, when they reimburse their executives for travel, it's going to be using a per diem because it's a lot easier for their accounting departments to deal with it when they don't have to add up the individual expenses. It's to ease record keeping requirements for the business, basically. So to ease record keeping requirements, a business may elect to use a federal per diem rate as an alternative to keeping track of employees' actual expenses during business travel away from home. This allowance is in lieu of tracking actual travel expenses. It's in lieu of tracking actual travel expenses, which means the business gets to choose. They can choose either or. The applicable per diem rates vary based on whether the travel is domestic or foreign and also by the location. For example, the per diem rate in large cities like Los Angeles or New York is higher than for smaller cities. And this is something that you can look up. It's right on the IRS website. There's also per diem rates for foreign travel. If, for example, you have a situation where you're sending an employee overseas. A self-employed person can only use a per diem rate for meal costs. Per diem payments are not included in an employee's taxable wages, so they're excludable from the wages. They're reimbursements, basically, for the employee, if the employee submits an expense report to their employer. So the reimbursements have to be made under an accountable plan. Claiming the per diem is not mandatory for any business. The IRS allows businesses to use per diems as an alternative to actual meals and travel expenses paid. It's an alternative to basically doing all the bookkeeping with actual costs. Examples. Abbott & Abbott LLP is a CPA firm that employs dozens of auditors. The company's main office is located in Texas, but twice a year, all of the auditors travel to Florida to a different regional office for mandatory employee training. They typically train there for several days. Abbott & Abbott allows the employees to use federal per diem rates when they submit their expense reports for reimbursement. The employees are pleased because they do not have to save receipts for every meal purchase. And this is really typical. When I worked for a CPA firm in Northern California, they would reimburse the employees for per diem whenever they sent the CPAs out on audits. Many times those CPAs would have to be on location for an entire week, sometimes 2 weeks, and they would just stay at a hotel And the company, the CPA firm, would book the hotel and also pay for the hotel using a company credit card. But then the employees have to eat while they're there. So they would go out and buy whatever they wanted or go to like little restaurants around the hotel or near the area where they were actually performing the audit. But then the company would just give them per diem in order to pay for their meals so that they wouldn't have to, be keeping every single little receipt for their meals while they were there performing the audit. So this is really typical, especially with a larger firm, because they don't want to deal with the additional bookkeeping of tracking actual costs. Example number 2. Kaufman Consulting, Inc. is a financial services firm with 20 employees. So now this is a smaller employer. The company reimburses its employees for meals and incidental expenses when the employees are traveling for work-related business. Instead of using the federal per diem rates, Kaufman Consulting requires all of its employees to submit actual receipts for all of their meals and travel costs in order to obtain reimbursement. This is their company policy. And it's the company that gets to make this choice, not the employee. The company chooses whether or not it's going to reimburse its employees for actual costs or reimburse its employees for per diems. And the employees basically have to follow the policy of the company, otherwise they're not going to get reimbursed. It's the company's choice. Transportation expenses. Ordinarily, expenses related to the use of a vehicle for business can be deducted as transportation expenses. Self-employed individuals may choose to use either the standard mileage rate or actual expenses in order to figure the deduction for their vehicle. Corporations generally cannot use the standard mileage rate. However, businesses, including corporations, may reimburse an employee under an accountable plan for business-related use of his or her car using the standard mileage rate. So if the corporation owns the car, then it's providing the car as a fringe to the employee. In that case, the corporation is going to be deducting actual costs, not standard mileage. If the corporation doesn't own the car, and the employee is using their own car, which they own, in order to, run errands for the corporation, then in that case, the corporation can reimburse the employee for their mileage, for their business-related mileage. That's usually what people do if they have an S corporation or a C corporation, and it's like a single shareholder company. They will reimburse the employee or the owner of the company, the shareholder employee, for the use of their own vehicle, if the shareholder owns the vehicle and not the corporation itself. But self-employed individuals can choose either actual costs or the standard mileage rate. Either or, it's fine. A taxpayer who elects to use the standard mileage rate cannot deduct actual expenses of operating a vehicle, such as gas, oil, and insurance. It's either one or the other. You're either going to take standard mileage or you're going to take actual costs. You don't get to do both. However, parking fees and tolls may be deducted in addition to the standard mileage rate. And remember this for the test. I feel like this is a little bit of a trick question because if you have a vehicle and you choose the standard mileage rate, or if you choose actual expenses, you get to deduct parking fees and tolls in addition to that. Whichever one you choose, you still get to deduct parking fees and tolls. And we're not talking about parking tickets, though. Parking tickets are what you get for breaking the law. You're parking illegally or you're double parking on a city street or something, and then you get a parking ticket. That's not what I'm talking about. Parking fees are like when you feed the meter. You're like in downtown area and you have to pay to park, or you have to pay in a parking garage in order to park downtown because you're running a business errand or whatever. That's a parking fee. And then tolls are when you like go over a bridge and you have to pay the toll to go over that bridge. Those are deductible in addition to either the standard mileage rate or actual costs. Either one, you still get to deduct parking fees and tolls. They're just separate. Let me give you a few examples. Darius uses a delivery van in his landscaping business. He has no other car, so the van is used for his personal transportation on the weekends. Darius chooses to deduct actual costs rather than using the standard mileage rate. Based on his records, Darius's total vehicle expenses are $6,252, which includes the cost of diesel fuel, oil changes, tire replacement, and repairs. Darius uses the vehicle 75% for business, so his allowable auto expense deduction using the actual expense method is $4,689. So he would have to allocate the amount of his personal use as well as his business use, and in order to figure out the deductible portion of his actual expenses. So with 75% business use, then this is the amount that he'd actually be able to deduct on Schedule C. Example number 2. Coldwell Dairy Farms, Inc. is a C corporation with 25 employees. The corporation has an accountable plan for reimbursing employees for business mileage based on current IRS mileage rates. At the end of each month, each employee submits a detailed spreadsheet that lists their business-related mileage. So the employees are using their own cars to run errands or to work for this company. And then in that case, the C corporation can reimburse the employees for the use of their own vehicles using the standard mileage rate. Caldwell Dairy Farms issues a reimbursement check to each employee on a monthly basis. The reimbursements are not taxable, so it's done outside of payroll. Those reimbursements are not taxable and they're not included on the W-2. And they are fully deductible by the corporation as transportation expenses. So they would be 100% deductible by the corporation and not taxable to the employees. That's a reimbursement under an accountable plan. Let's talk about when you cannot use the standard mileage rate. A business is prohibited from using the standard mileage rate if it operates 5 or more cars at the same time. This is considered a fleet, and then in that case, that business has to use actual costs. They can still deduct those expenses, but they just can't use the standard mileage rate if they operate a fleet of 5 or more cars at the same time. If the business claimed a depreciation deduction using any other method other than straight line on the car, it's okay if you take actual costs on the car and then switch to standard mileage. You can do that, but not if you took any other type of depreciation other than straight line. Straight line is the most conservative method of depreciation. If you take Section 179 on the car, or if you take bonus depreciation on the car, you cannot use standard mileage. You're stuck with actual costs forever on that vehicle. The only time where you can use actual costs, when you have a car, you can use actual costs and then switch to the mileage rate afterwards, is if you used straight line depreciation on the car. Then it's allowed. Then you can switch. But if you took Section 179 or bonus depreciation on the car, or any other type of depreciation other than straight line, then you can't switch to standard mileage after. Okay? If you claim actual car expenses for a car that was leased, that's the other time, And I think you need to know this for the test. And let me give you an example. Perfect Shuttle, LLC, is an airport shuttle service that operates in San Diego, California. Perfect Shuttle provides airport transportation as well as a luxury car service. The company employs 10 full-time drivers and operates a fleet of 15 shuttles and limousines. The business cannot use the standard mileage rate because it operates more than 5 cars at the same time. The business can deduct the actual cost of maintaining and operating the vehicles, and that's fine. But since it's a fleet, they can't use standard mileage. It's more than 5 cars.
The next webinar covers business gifts.